Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we have a special guest in Maria Dawes. Maria is a portfolio manager at Capstone Asset Management. She's a certified financial planner as well as a CIM, a chartered investment manager. Capstone is one of the investment firms we partnered with. We refer clients to out of our office here. So BCV Asset Management is one we talk about a lot. We've had Chris on the channel a few times. Maria, this is the first time we've had her on the channel. We will continue to have her more, just talking about how they manage money a little bit differently. Not just about them, but just about general markets, how to approach investing in your portfolio, how to mitigate risk, how to kind of structure stuff as you're entering into retirement. A lot of people like the dividend value approach that I personally invest in. That's kind of the BCV approach to it. The Capstone approach is more non-discretionary investments, non-traditional investments. It's a little bit different. And so Maria's going to talk about that today, how adding that into your portfolio can actually mitigate or reduce the volatility within your portfolio. And as we're going through markets like this, as you know, it's hard to sleep at night sometimes. A lot of you are losing sleep on a daily basis because your portfolio is dropping by 1, 2, 3% every single day. So part of this video with Maria is really talking about managing risk, managing your portfolio, looking at structure. So we want to welcome Maria to the channel. Hopefully it brings value to you guys. If you have any questions for Maria, post those below and we'll get her to answer those for her. So welcome her to the channel. Thank you for joining us. So today Maria is here. Maria's from Capstone. I'm going to let her just talk about Capstone, what they do, who they are. You know, we partnered with them as an investment firm for our clients because they do a great job and they do stuff a little bit differently, and that's again why I want Maria to kind of go through that, their model, and why they do what they do. So thank you for joining us.
Thanks for having me. So Capstone's been around since 2004. We are registered as a portfolio manager and investment funds manager in most provinces in Canada. I think what makes us different is we incorporate non-traditional investments in our portfolios. So we manage the traditional side, the stock, the bond, that's what most people are familiar with, but we also incorporate non-traditional investments. So I'll give you a little bit of a background on why and what happened that made us move in that direction. So I've been around with the business since it started back in the day, and we all went through 2008 with a lot of cringeworthy moments and a lot of pain, and we had a lot of stressed investors who were invested in the stock market and the bond market, and everything went down together. And one thing we learned is that in moments of crisis, and we've seen it since 2008, correlations tend to go to one and everything moves in the same direction, which is usually down, especially in the traditional markets. There's a lot of volatility there, right? And so everything responds the same way. And we learned that the clients who were the less stressed or the least stressed, those clients had investments in things other than the stock and the bond market. So they had those too. But they had real estate, they had private businesses, they were lending money and receiving interest back on mortgages, private mortgages in lots of different arenas. And we realized there's got to be a better way to just managing stock and bond portfolios. There's got to be a way to better diversify an investor's portfolio. And so in 2012, we launched our first fund, the Capstone Mortgage Pool, and it's an investment that lends money in the construction real estate space. So it's a mortgage portfolio. Since then, we've been incorporating this strategy into our clients' portfolios. We've added other mortgage strategies. We've added non-traditional equity strategy. We've incorporated private lending into a fixed income strategy. So we really feel like we can offer our clients a real diversified portfolio. You want to have investments that move in different directions depending on what is happening in the economy.
You don't want your whole portfolio to kind of move in one direction. If something's going this way, you want something else to go this way and kind of balance itself out.
Exactly. Because if everything moves the same way, it's all going to go down at the same time. I mean, it'll go up at the same time too, but you don't want that downside volatility to be as strong. You want to have some protection on the downside. So incorporating things that move differently in the non-traditional market will really help protect you when things are going down. And some people can't wait for those portfolio returns to recover.
And a lot of our clients are that. Like a lot of people watching this are in retirement or very close to retirement. Yeah. And the old school way of thinking of that is equities and bonds. It's like, well, I have my bonds and my equities and they do different things. So, but now you guys have added like a massive layer of non-traditional, which is again, mortgages and real estates and stuff that people don't typically see. And honestly, when I started talking to you, we were talking about this earlier, when I was introduced to Capstone, I'm like, I've heard of MICs, like Mortgage Investment Corps, which are quite big in BC. The rest of the country, they're not as big. I always thought like, hey, this real estate play and a lot of stuff what you guys do, I kind of thought you had to be like a multi-millionaire or a billionaire to kind of have access to this. And you know, when I did more digging on you guys, it was like, okay, the average Joe, average Canadian can actually get access to a unique investment pool that a lot of people don't know they can get access to?
Yeah, there's a lot of barriers to entry. A lot of the clients who were accessing it back in 2008, in my days then, they were, putting millions of dollars into maybe one or two different projects or one or two different strategies. Whereas we thought, okay, we still want to have diversification in these strategies. So developing a fund structure allows us to create economies of scale. You get diversification. We can access lots of different strategies in one fund, and we can do it as cheaply as possible because there's costs to it that typically land up on the investor's lap. And if you aren't a millionaire, multi-millionaire, that can sometimes be a real obstacle to accessing this market.
Yeah.
So being able to access it in a fund structure definitely helps. I mean, there are risks though.
Yeah.
Don't get me wrong. There's no free lunch ever in the investment
Yeah.
world. You may not have this massive amount of volatility, but you still have other things. Mortgages are inherently illiquid. It's a debt, it's a mortgage. So you may have to tie up your money for some time, 6 months, 1 year, whatever the case might be. And if the mortgage market goes into crisis, it could be longer. That's the risk you're taking, but you're also getting a reward for it. Oftentimes you're getting a really stable rate of return. Investors who are looking for income, that's a really fantastic way of finding income in this market with really low interest rates and being able to buffer some of the inflationary pressures. Inflation typically actually goes against both the bond and the stock market. You see interest rates rising, the bond market sells off.
We're seeing that right now.
Right? The stock market gets really volatile. So having something in your back pocket that helps buffer that a little bit is often really kind of peace of mind inducing and people sleep better.
And I know we talked about putting this at the end of the video, but we're going to throw it in now.
Okay.
So we'll throw the chart up right now of just the mortgage, your guys' mortgage pool,
Yeah.
compared to the TSX total return and a bond pool or bond fund.
Yeah,
So just
so-
showing how things have worked.
Exactly. So this is the Canadian bond market as a whole and the TSX. And you can see the volatility, you can see how rapidly it moves up and down. And if you have a long time horizon, then you can wait that out. If you don't need to take money out for income regularly, you can wait that out. But if do, if that's going to be a problem, you can see how the Capstone mortgage pool, a mortgage strategy, we have other strategies too, but how this one is an example, it is a very smooth, consistent rate of return. Now, you're not going to get those outlier high returns either, right?
Yeah,
So
it's
people,
consistent.
it's consistent within a very kind of narrow, predictable range. It helps bring your portfolio into a more predictable range, but you're not going to get those 20, 25% rates of return. So you have to set your expectations.
It's a piece of the pie.
It's a piece of the pie.
Yeah.
Exactly.
Yeah, for sure.
Yeah.
So talk about kind of non-traditional investments that you guys do and where that fits in. Because a lot of people will be watching and saying, okay, well, I'm in ETFs or I have a stock portfolio. And I mean, everyone's getting crushed right now in the market.
Yeah.
So I thought this would be a good time to bring on Maria and say,
Yeah.
like, there are other options out there and this and that. It's not for everyone, but it's for a lot of you. And a lot of you are drawing in income. And how do you create stability? Now, part of that I always talk about is a plan. So if you have a plan, you know what your cash flow need is, then any portfolio manager or yourself, you can build your portfolio to match your cash flow needs. So that's kind of step one. But step two is I need my money working for me because inflation's like 4 to 8%, depending on what article you believe. But it's high. It's really high. So even, GIC rates with inflation going up, interest rates going up, you can get a GIC right now 2-3%, which is still under that inflation mark. So how do we add in these non-traditional? How does it work? And kind of how does it level out or reduce the risk within the portfolio?
Yeah, so as I mentioned, they're not typically as volatile as the traditional market. So in that way, you can moderate that rate of return over time while keeping that volatility profile more attractive or more stable. So it averages that out a little bit more. But I would say the first thing you should look at is the whole portfolio as one big pie. And then based on your risk tolerance, your time horizon, your liquidity needs, then start looking at how much do you want to carve out of your portfolio that should not be invested in the stock market. And maybe not even in the bond market right now. Maybe you have to hedge out that a little bit too and look at what else is out there. And then from there, it's a matter of location. So where am I going to actually keep those investments? So just a side note, when you're looking at your entire portfolio, you've either got an RSP, a TFSA, maybe you've got a corporate account, an open account. So then you start looking at which is most tax efficient and which is least tax efficient. Now, the mortgage pool is not very tax efficient because it distributes interest income, and that's taxed just like your normal income would be. So if you can dump that into your TFSA, if you can put it into your RSP, you're not going to get 20% return, but you might get a 7% consistent rate of return, and that is tax sheltered. and you stick your stocks into your open account or your corporate account, because they're hopefully, if there's capital gains, then those are going to be more tax efficient.
Yeah, and that's a good point, because when I talk to people on the phone, people are looking and they have a non-registered account or a corporate account. Those are the two accounts. If you have RSPs and TFSAs and your typical Canadian investment accounts for retirement, it's somewhat simplified on the tax side of things. But when you add in, if you have a non-registered account, if you have a corporate account, if you're sitting in mutual funds and that type of product, like, you really need to give us a call, talk to Capstone. You need to make a change in your investments, because your money is not working as it should be, especially in the non-reg and corporate side of things. So talk about just like adding non-traditional versus just your typical portfolio, the risk, the return, how that non-traditional actually lowers risk, smooths out the bumps, basically.
So let's talk about risk first, right? There's lots of different risks. Most people think risk means volatility. And I just talked about how a mortgage strategy might have something other than volatility. It would have liquidity risk, for example. So what we're looking at in this case is, how do we mitigate that volatility risk? And so what I did is I grabbed a 50-50 portfolio, 50% Canadian bonds, 50% equities, kind of split between Canada, US, and global. And we see we've got a volatility score of just shy of 8 and a rate of return of just around 7-ish. And that's pretty typical. If you go to a bank, they're going to probably give you, a 50-50 portfolio that has exposure to the broad market. So it's just a sample, right? If you start incorporating non-traditional investments, both fixed income, so like I said, mortgage is an example, there's lots of other things too, but also non-traditional equity. So what are some of the most common? Most of you have non-traditional equity, actually, because you own a home. And so that would be a non-traditional equity investment. You own the equity of a home. Private businesses is another really great example. So you add that into a portfolio, you add the stock market exposure to that portfolio, and all of a sudden your volatility, because non-traditionals tend to be more stable, it comes right down. So our volatility comes from like a 7% down to maybe a 4. Sometimes I can get it as low as maybe 2 or 3, depending on what my allocation is, and depending on what the risk profile and the investment objectives are for the client. And that helps really define the return probability in the portfolio. So I'm going to get a little bit technical here. Standard deviation is a mathematical term for volatility. So if you're ever wondering what your mutual fund's volatility score is, ask for its standard deviation. It'll tell you how rapidly things move up and down. Typically, the stock market in Canada is somewhere in the neighborhood of 12 to 13, depending on the time horizon you look at. The bond market's anywhere between 4 and 5. It's right up there at 5 right now because of how volatile it is. So that just kind of gives you some parameters to work with. If you take a non-traditional investment, it might be only 1 or 2, and it's uncorrelated to the stock market. So when the stock market does its thing, it's just plugging away depending on whatever kind of underlying industry its exposure is in. When you add these non-traditionals, you can pull that standard deviation, the measure of volatility, right down. So if its average rate of returns, maybe over 10 years is 7-8%, so say it's standard deviation 13, like the stock market, and on the upside, you're going to have a swing of like -7 to maybe 20-21%.
Crazy. Yeah, which is what we're seeing now, right?
Right, exactly. That huge roller coaster. There's going to be outliers too. Don't forget that. So you're going to have the odd year where you've got like -10, -15, and +30. And then you're going to have a portfolio with a lower standard deviation, and its range may be only 1 to, let's say, 19-20%, or maybe even 16-17. So you're limiting a bit of your upside potential, but you're also shoring up your downside risk. And that's important for people who can't sleep at night when their portfolio is negative, right? Yeah. And for those who need to draw on income and can't wait for the recovery. So we try to say, okay, what is that range of probability that we're targeting, and how close do we have to actually get to it? And then we start constructing a portfolio. Yeah.
So the last thing I want to talk about today, so as we bring a client into Capstone, I know, which is very unique to Capstone, I think, typically you go to an investment firm and it's like, I want 70% stocks, 30% bonds. But because you guys have more pieces of the pie, what's really unique is when you partner with Capstone with your investment portfolio, you can actually kind of build out, okay, I want some traditional, some non-traditional, some mortgage, some this. So you can actually like kind of make the pieces of different parts of the pie bigger or smaller depending on your risk and what you're looking for and stability and all that kind of stuff. So it's very unique and very customizable that way.
Exactly. Some people hate the stock market and they want nothing to do with it. So we try to construct a portfolio that excludes it, and we can. Some people love the stock market and want lots to do with it, and they're just hedging their bets on the non-traditional side. So we do that. So it is customizable, and I think we can meet most risk
Yeah, no, like the latest client we brought to you guys, they were very scared of the stock market, but they understood it probably made sense from, just a portfolio structure to have a little bit. So I think their piece of the pie was 15% traditional equity.
Yeah.
And then the rest was non-traditional and mortgages and fixed income and all of that. I looked at their portfolio this morning before it came in, and it's up on the year. It's actually, which is crazy to think. So the process works barely. Barely, but it's up. But the process works. And I think it's just, your guys' portfolio kind of shows like having uncorrelated items to the market in times like this, especially. Now, when the market goes crazy, you tell me, but like they might not work quite as well. But again, like what are you looking for? You have to go back to what is the right portfolio for you? Yeah. Do you like the bigger swings? Do you want smaller swings, but you're okay with a bit of a slightly lower average rate? It's still a great rate of return, but slightly lower, but you want less swings, right? I always say it's going up the elevator with a yo-yo, right? Like how much do you want that yo-yo? We're going to go up. But how much do you want that yo-yo to go up and down?
And knowledge is peace of mind, isn't it, right? So setting your expectations, saying, oh no, what's happening now is within the parameters of how I constructed this portfolio. So this is not stressful for me. This is a normal behavior. Or is it, this should not be happening. This is not normal. I was not expecting this. Well, that's not what an investment advisor wants to hear.
Absolutely, yeah. And I think right now it's a unique time because even for me, like I look at my blue chip dividend paying stocks and they're down. I go to the underlying holding and say, okay, well, everything I own, I love. It's just, it's a temporary blip. I'm okay. I'll hold on. I don't need cash flow. But even for clients that have a portfolio like mine, and you need cash flow, you plan for that. And again, going back to the plan and all of that. Again, some people, they get into bad investments through bad advice. And then markets like this hit, or maybe through 2020, they were chasing the Shopify's. I mean, Tesla's down 30% this year. Like a lot of DIYers, your DIY investment approach started to fail you. And if it has, there's probably underlying issues to it, right?
Probably.
So it kind of goes back to either traditional or non-traditional. Know why you own what you own and have a plan behind it all.
And if it terrifies you to be in the stock market right now, you probably shouldn't have been there in the first place. But if you're thinking to yourself, hooray, buying opportunities, then hey, you've made the right decision.
Yeah, absolutely. Yeah. So thank you so much for joining us. We'll have you back on again. If you guys have any questions for Maria, put it below. We'll also link her contact information below as well. If you have questions for them, for us, for planning, recreate your portfolio with some non-traditional, give us a call or check out our website, parallelwealth.com/planning. Thanks for joining us.
Thank you.